And Carnival, that is up 4%. Here's the closing bell.
That marks another down day here for the market. Dow closing off just around 91 points. S&P off around 0.8%. NASDAQ off 0.6%. You're looking at the Dow in negative territory. We actually were up over 300 points at the highs of the day. Taking a look at the sector action, communication services, energy, and technology, the only sectors to close in the green this afternoon. For more on this, let's bring in Rhys Williams, a Spouting Asset Management Chief Strategist. We also have Teddy Parrish, a Parrish Capital CEO and CIO. Teddy, let me start with you because we certainly got a number of strong earnings reports over the last several days. It looks like the market, though, largely shrugging that off, focusing more so on what we're hearing from Fed officials. But what's your takeaway of the action that we've seen today?
Well, I think the market's anticipating, some downgrades in earnings. We haven't got much of that lately, but even if we do have a great earnings season and not much in the way of downgrades to estimates, I think the market action is still going to hinge on the fact that the Fed is still there, waiting to push rates up and to eventually push us into a recession. So that's a black cloud that is not going to go away because inflation is still there and it's excessive. So the Fed's going to be vigilant, and they're going to continue to be until they see signs of inflation actually subsiding.
Yeah, no signs of it yet. Rhys, thematically, what are you seeing, generally speaking, from earnings and your expectations as we head towards big tech earnings?
So in general, I would say earnings have been maybe less bad than feared. I mean, I think there's a lot of uncomfortableness about how things were going to be playing out. And in general, if you came in with pretty low expectations, no matter what you reported, the stocks have gone up. Similarly, actually, if people had high expectations for you, if you were in a rather defensive sector, some of those stocks have actually sold off. So it's been a little contrarian in terms of stock performance. But in general, I don't see any huge downgrades, I would agree, in earnings estimates for the fourth quarter relative to expectations. I think that's more likely to come into the first quarter as the economy continues to slow.
Teddy, you mentioned the fact that you expect the Fed to remain hawkish and to keep raising rates. I guess, to what extent is that going to push us into a recession, and how deep could that recession potentially be?
Well, we would hope that the recession is shallow, but the Fed has never been on a path of increasing rates this far, so fast, and not push us into a recession. So the chances are probably pretty high that they're going to continue to push rates up. And, the economy's pretty healthy, consumers pretty healthy, and corporations are pretty healthy. So with that backdrop, I think that it could be a shallow recession, but to the extent that, rates are not just pushed up to a point of actually stalling the economy. One of the main things that has to happen is for money supply to actually decline, and we haven't had a whole lot of that. But because it's not like they can go in and actually take money out of consumers' checking accounts. So there are a lot of moving parts and some other potential issues outside of just the Fed that could make a recession more deep. We hope that it's shallow, but we don't know.
Teddy, do you think the Fed should pause? Do you think they're over-tightening?
No, I think it's necessary.
Okay.
I think it's necessary. I think that inflation is embedded in the economy. And, wage inflation is very sticky, and it's on the cusp of becoming secular. And the labor pool is such that it can't be expanded very fast. So I think they need to address the issue. I mean, we've had a whole generations of easy money. I mean, after 10 years of very easy money, we had to pay the piper at some point, and we reached that day.
What do you think, Rhys? Do you agree?
I would take the other side of that with due respect. I think the Fed should, if not pause, at least raise more slowly than they are. I think the consensus is they're going to go 75 and then maybe another 75 in November and December. I just think that's too much. And I think everybody's very focused on the CPI numbers, which are alarmingly high. but a lot of that is in how they calculate the rent. And actually rents went way up more than the CPI reflected in 2021. And actually they're starting to kind of roll over now. So I just think there's a lot of anecdotal evidence from commodity prices to, what's going on in the housing market to auto sales, that things are starting to really slow. And then that doesn't even talk about what's going on overseas, because the idea that Europe will be anything but a severe recession is super unlikely. And then China is its own little drummer. And, that has been the engine of growth for the last 20 years. And frankly, that's missing in action right now.
And Teddy, given all the macro conditions we've talked about, how do you, any sectors, any names you like?
Well, we're high value growth at a reasonable price, core managers, equity managers. So we like a lot of things now. We're overweight staples, healthcare, industrials, and even financials at this point. We think that a lot of damage has already been done, especially in some of the higher flying areas. And there are some great values. If you look inside the NASDAQ 100, for instance, companies have gotten slaughtered over the past year. And I think that you can sift through those companies and find some great long-term holdings in technology as well. But we like names with high dividends, high and growing dividends, great balance sheets, which should flow down to a better cost of capital in this higher interest rate environment.
Rhys, given the uncertainty out there, where are you putting money to work? And I guess where are you seeing the most opportunity?
Well, I think sort of one contrarian opportunity right now is REITs, and that is that they've done really poorly this year because the bond market has done so poorly. And I think everybody's very consumed with the fact of how far the Fed's going to go. But no matter what the Fed does in November and December, I think long rates are close to peaking, and that should be good for REITs, which basically are priced off the 10-year. So I think there's a little bit more room on the upside for the 10-year yield. But anything goes any higher than this, a mild recession turns into something worse 6 months from now. So I definitely think the bond market's going to start sniffing out recession and start being your friend going forward.
Good stuff there. Rhys Williams, Teddy Parrish, thank you both. Appreciate that.